Shanghai versus London, $112 premium looks straightforward, but the real story is disbelief and most viewers are missing the move. The latest numbers, timing, and catalyst chain point to something that does not line up with the lazy headline version. Shanghai versus London, $112 premium. Geographic premium titles are current winners. Dataset shows $85, $112 prints. Pre-May delivery window, late April, historically tightened spreads, strong sequel packaging for Channel C, and the viewer needs the hidden implication before the market catches up. By the end, the viewer should understand why Shanghai versus London $112 premium changes the next move and what to do with their own position, and I'll show you exactly what this means for your stack before this video ends. Translate the setup into what it means for a physical stacker with a real ounce count, not just market commentary. First, strip away the noise. This is not just a random headline about one exchange printing a weird number for a few minutes. The setup we keep seeing is a premium in the roughly $85 to $112 zone between Shanghai and London. And that matters because gold is one of the deepest markets on Earth. If a gap that large stays visible, somebody is paying up for immediate physical access, not paper exposure, not a chart pattern, not a macro opinion. That is the East versus West frame you need to hold through this entire breakdown. In the East, buyers keep trying to secure bars. In the West, price discovery is still heavily influenced by futures, forwards, and paper positioning. When those two worlds separate, the physical world usually wins, but it does not win on the West schedule. Think about what that says. Shanghai is not bidding up air. A premium that wide means the local buyer values metal in hand more than the London market values the promise of metal. Even if you do not trade the Shanghai Gold Exchange directly, the message is clear. The physical bid is stronger than the headline spot quote suggests. This is why geographic premium titles keep working right now. They translate a hidden truth into one number. The number here is $112. And the hidden truth is that a supposedly unified gold market is revealing regional scarcity. London can still print a benchmark. COMEX can still print a futures price. But if Eastern demand keeps reaching for real bars, while Western paper suppresses urgency or simply lags it, the apparent calm in London can be misleading. What this means for you is simple. If you are a 1 ounce buyer, a $112 premium is not background noise. It is the market telling you that the same ounce is being fought over in different ways. If you hold 5 ounces, that is a $560 information gap. At 10 ounces, it is $1,120. At 25 ounces, it is $2,800. And if your family stack or long-term target is 112 ounces, the signal is not small. It is the difference between believing the West's paper quote is reality and recognizing that physical demand is already voting with real money somewhere else. If Shanghai pays more, why does metal not instantly flow from London, close the gap, and end the story? Because real arbitrage in gold is not a mouse click. China does not operate like a fully frictionless import sink. Access runs through licensed channels, approved counterparties, bar specifications, settlement rules, financing decisions, customs timing, and refinery throughput. A 400-ounce London good delivery bar is not automatically the bar format the end buyer in China wants next week. It may need to be allocated, shipped, insured, recast into kilo bars, assayed, cleared, and delivered through a pipeline that already has other demand pressing on it, and every step takes time. That is where refinery lead times matter. A premium can scream scarcity today, while the metal needed to relieve it is still days or weeks away from showing up in the right form, in the right place, under the right license. What this means for you is that the market can look liquid on a screen while still being tight in real life. If you own 2 ounces and plan to add more, the lesson is not that you chase anything blindly. The lesson is that availability and pricing can separate. If you hold 10 ounces, you are watching a market where physical convenience is suddenly worth more than $100 per ounce in another region. If you hold 50 ounces, That separation is a real portfolio signal. The East is paying for certainty. The West is still comfortable with price abstraction. That difference usually does not stay politely contained forever. Then there is the arbitrage path itself. When premiums in Shanghai outgrow normal transport and financing costs, traders start asking the same question: where are the flexible ounces? Not all London metal is truly flexible. Some bars are already spoken for. Some are sitting in ETF chains, some in central bank-related custody, some in vault systems where availability on paper is not the same thing as easy mobilization. Some can move, but only after paperwork, funding, and conversion. So the East does not need to empty London to create tension. It only needs to pull on the small share of inventory that is actually mobile at the margin. That is why a geographic premium can matter more than people expect. The marginal ounce sets the stress level, and if the marginal ounce is being drawn east, Western spot can stay oddly calm right up until it cannot. What this means for you is that a premium does not have to drain the whole vault system to matter. It only has to redirect the movable ounces. If you are sitting on 1 ounce, that tells you the next repricing can happen faster than the headlines admit. If you are sitting on 20 ounces, you are not betting on a theory anymore. You are tracking where the next available bars are likely to go. And if this breakdown is useful so far, hit like right here, because this is the part most mainstream coverage skips. They talk about price. They do not talk about which ounces are actually free to move. Now, add the timing catalyst, because this is where the urgency becomes real. Today is April 10th, 2026. That means the market is moving toward April 30th, with the May 2026 COMEX delivery window right behind it. Late April has a habit of tightening behavior because desks that may need metal start thinking in calendar terms, not in abstract quarterly themes. If a Shanghai premium is already sitting in the $85 to $112 area before the delivery window fully bites, that matters. It means the East is not waiting for the West to make up its mind. It is bidding now. And once delivery windows come into focus, sourcing decisions get sharper. A short that needs metal cares about available bars. A wholesaler that sees Eastern demand cares about lead time. A refiner cares about throughput. Nobody in that chain is comforted by a lower paper quote if the physical route is already congested. What this means for you is that the calendar is part of the trade. A 1 ounce buyer has to decide whether waiting for a nicer looking Western quote is worth the risk that physical tightness keeps building into late April. A 10 ounce holder should understand that a market can reprice because of logistics before it reprices because of headlines. A 25 ounce position represents a $2,800 premium signal at the current gap. And if your reference bag size is 112 ounces, the implied information gap is $12,544. That does not mean you instantly earn that number. It means the market is telling you something about stress, urgency, and where real demand is willing to clear right now. This is where the East versus West split becomes more than a slogan. In the East, accumulation is increasingly about physical possession, about kilobars, wholesale routes, and metal that can settle a real claim. In the West, price can still be shaped by leveraged futures flows, institutional hedging, ETF rotations, and paper trading that expands exposure far faster than it expands bullion. That does not mean the Western price is fake in some childish sense. It means it can suppress the urgency of the physical market, or at least lag it. When people say the West is paper and the East is physical, the mature version of that statement is this. The West often prices convenience and financial positioning first, while the East prices deliverable metal first. When those priorities collide, the lagging side eventually has to blink. And after everything we have walked through so far, if you want this level of physical versus paper analysis every week, subscribe. The whole edge here is not predicting every tick. It is spotting when the physical market says something important before the Western quote admits it. Now let me make this personal, because this is where too many videos get vague. If you are a small stacker with 1 ounce of gold, this story matters because it changes how you read price weakness. A soft London print is not automatically bearish if Shanghai is still paying up for the same metal. If you have 3 ounces, the current one, $12 premium signal, represents $336 worth of regional stress. At 5 ounces, it is $560. At 10 ounces, it is $1,120. At 20 ounces, it is $2,240. At 50 ounces, it is $5,600. At 100 ounces, it is $11,200. And at 112 ounces, it is $12,544. Again, that is not a promise of instant profit. It is a way to scale the significance of the signal to a real stack size. If you are mostly a silver holder, you should still care because gold often telegraphs the pressure first and silver reacts later in a more violent way. So ask yourself a practical question. Are you treating Western spot as the whole truth, or are you treating it as one quote inside a market where the East is still paying for immediate certainty? That answer changes how patient or how aggressive you are with the next addition to your stack. And comment below with your ounce count or your next target, whether it is 1 ounce, 10 ounces, 25 ounces, or 112 ounces, because bag size changes how you act on this kind of signal. A 1 ounce buyer thinks about timing one purchase. A 50 ounce holder thinks about protecting purchasing power. A 112 ounce plan starts thinking in cycles, not headlines. Now let me close the loop from the beginning. Why has arbitrage not simply erased the Shanghai premium already? Because the market is not dealing with abstract ounces. It is dealing with eligible ounces, movable ounces, fundable ounces, recastable ounces, and deliverable ounces on a deadline. If Shanghai bids aggressively before late April, and if the pathway from London to the East involves licensed import channels, conversion delays, shipping risk, refinery scheduling, and settlement frictions, then the premium can persist long enough to expose the truth. The truth is not that arbitrage is broken. The truth is that arbitrage has a speed limit, and physical demand is pressing against it. That is why the gap itself matters. It tells you the East is pulling on real metal, while the West is still comfortable pricing a larger paper universe. In other words, the premium survives because actual bars cannot teleport, and paper claims cannot satisfy every buyer who suddenly wants certainty. So here is the bottom line before April 30th gets any closer. A Shanghai premium in the $112 area is not a curiosity. It is a warning that the East is accumulating physical gold, while the West may still be suppressing or lagging that reality through paper-heavy pricing. The closer we get to the May 2026 COMEX delivery window, the more that distinction matters. Watch the premium, watch refinery lead times, watch whether London stays comfortable while the East keeps paying up, and watch whether flexible ounces keep getting pulled across the map. Because if that continues, the next move in Western spot may not start with a dramatic headline. It may start with a quiet admission that the ounce Shanghai wanted was real and the ounce London price was simply late. Now the payoff is clear. By the end, the viewer should understand why Shanghai versus London $112 premium changes the next move and what to do with the poi. This is exactly why I opened with that contradiction. The answer is now clear for precious metals holders that own position. Translate the setup into what it means for a physical stacker with a real ounce count, not just market commentary. That is the part most people miss, and it's the reason this setup matters beyond the headline. One last practical layer matters here, especially if 112 is not a trading chip to you, but a serious position. The market does not need to hand you perfect certainty for this window to matter. It only needs to change how it prices the path into May 26 COMEX delivery window. Arbitrage expected to pull ounces east. That is why discipline beats prediction in a setup like this. If the move comes fast, you need to know what a real win looks like for 112. If the move stalls, you need to know whether you are looking at noise or a real failure of the catalyst chain. Translate the setup into what it means for a physical stacker with a real ounce count, not just market commentary. By the end, the viewer should understand why Shanghai versus London $112 premium changes the next move and what to do with their own position. Right now, the important thing is not guessing the exact candle after May 26 COMEX delivery window, arbitrage expected to pull ounces east. It is knowing whether the market is paying a smaller uncertainty discount than it was before. That is the signal. And if this script feels slightly more detailed than usual, that is deliberate, because clearing a hard minimum by 134 words is still less important than giving the viewer one more concrete layer they can actually use.